Okay. Chapter 4 of the ETF book is benefits and drawbacks of ETFs. Okay. Okay. So positive aspects: trading flexibility, low cost, operational transparency, and tax benefits. Let's talk about this. Compared to mutual funds, why do we say ETFs have trading flexibility?
You can trade throughout the day.
There you go. That's it. You can trade throughout the day, right? And there's also no holding requirements too. Some mutual funds will say, "Oh, you have to hold the mutual fund for 30 days." You know, you can't day trade a mutual fund. Okay. Low cost. ETFs, because of their replication structure against benchmarks, have much lower fees than a typical mutual fund. Okay. Operational transparency. What do I mean by that? ETFs are more or less transparent, meaning you'll know everything about all the holdings in the portfolio. Why? Because it's matching a publicly available benchmark. So you'll know what you're holding in your ETF because it's transparent. In fact, they have to tell you what it's holding. You have the right to know what the portfolio is holding at all times. Do most people look at that or request that information?
No.
Probably not, right? Tax benefits. So the tax benefits of an ETF are this. When you only pay taxes on the ETF when it's bought and sold, right? When you buy it, well, you don't pay any tax when you buy it. When you sell it, you make the selling choice. Like, all right, I'm selling my ETF today. Then you're going to pay taxes on your gains, or you're going to get a tax break on your losses. However, with mutual funds, there's the dividend and interest component to mutual funds that have to be paid out to all shareholders when they're incurred. So, for us, for most of us, except Ben, who's living large, we wouldn't worry if we got like $200 in dividend interest, right? But if we were, a multi-millionaire and we were worried about tax purposes and things like that, we might have like $50,000 of interest coming our way. And we might not want to have that additional income pop in this year because it might put us into a different tax bracket or some other reason. So when you're invested in mutual funds, you don't have as much control of when you get income, right? Income can come from mutual funds kind of at any time, right? Whenever there's a dividend or an interest or things like that. So when we talk about tax benefits, you just have more control over how you're taxed and when you're taxed in an ETF. Okay? Trading flexibility, just talked about this. ETFs are bought and sold throughout the day. Near instantaneous trading, easy to move between asset classes. So if in a given day I want to say, all right, I want to get out of utilities and I want to buy into consumer discretionary, ETFs. It's really easy in the middle of the day just to switch gears. Also, short selling is available. We all know what short selling is, right?
Mm-hmm.
Okay. You can short sell any ETF, right? So if you get, I know I've talked about that. There's inverse ETFs that are products specifically designed to go up when the market's down, or go down when the market's up. But you don't even need an inverse ETF to do that. I can just short sell an S&P 500 ETF if I think the stock market is going to go down. Yes, sir.
Short selling is the same thing as selling short, right?
Yeah.
Sure.
You almost said the exact same thing twice. Lower cost. Fund admin costs go down when a firm does not have to staff a call center. So with a mutual fund, a lot of times they'll have a call center, right? And ETFs don't have that, right? They don't need that service. They're traded like a stock. They're not traded by a distribution of brokers or salespeople or anything like that. Statements are given on a much lower frequency than with mutual funds. Only, I think, semi-annually they're going to have statements. There's an absence. There's no mutual fund redemption fees. Remember how we talked about back-end fees and front-end fees and stuff like that? None of that with ETFs. Okay? And then generally lower broker commission fees are charged. In fact, I think it's Fidelity has a deal with iShares. iShares is one of the biggest ETF producers around, and they have a deal with Fidelity where they won't even have, you don't even have to pay any commission to trade ETFs, right? They'll just let you buy and sell ETFs free of charge. Compared to buying a stock, when remember I said you have to pay $10 to get in and $10 to get out, you can save a significant amount of money by doing that. Compared to a mutual fund, the holdings of an ETF are completely transparent. The tax benefit is a byproduct of the AP mechanism. The AP process removes the gains that would have been distributed to shareholders under the mutual fund, and dividends are taxed based on the length of time the fund has been held, not you. What do I mean by not you, right? It means this. So you could buy a mutual fund, an ETF, that has a dividend kind of, think of it as like built into it, right? They don't distribute the dividends because the dividends are captured by the AP process, but it's still incorporated into the overall profit of the fund, right? But the dividends are taxed based on how long the ETF has held that security, not you. So when we think about like when we buy a security, if I bought a stock and sold a stock within 30 days, I'm going to get taxed at a really high rate because it's considered day trading. But if I hold a stock for like 2 years, 3 years, I think the tax on it is like very, very low. It becomes like under 15% or under 10%, very low. I think even after a certain point in time, does it drop to 0? I forget, but it drops to, I think, around 15% or lower. So the tax basis is based on how long the fund has held it, not how long you've held that ETF. Does that make sense? Okay, negative aspects. Trading costs. We see that again, right? How can that be positive and negative? We'll get into that. Tracking error. Tracking error, remember we talked about cash drag?
Yeah.
Cash drag can cause tracking error, right? Because it won't let us replicate a portfolio purely. It won't let us replicate a benchmark 100%. Trading flexibility can also be a negative, right? And then settlement dates. We know a mutual fund will settle at what? T+1, right? But an ETF settles at what? T+3. Right?
What does that mean?
Trade date +3. So 3 days. But I could say 3 days, but in the industry, if you're ever talking to somebody who works there, they'll say T+3. They won't say 3 days. Just the same reason why they won't say, 2.5%. They'll say 250 basis points. So I try to have you guys get familiar with that, language. Trading costs. Buying a large variety of ETFs in small quantities can increase trading costs. So just like anything else, remember I talked about why buying a mutual fund can be efficient for your portfolio because you're buying a diversified group of stocks in kind of one swift motion. Well, the same can be said about ETFs in the opposite sense that if I want to buy, 30 different ETFs, let's say I want to buy, like a Japanese small cap ETF and a Brazilian ETF and a Chinese ETF and then a Russian ETF and then a S&P 500 ETF, there's going to be a trading cost associated with all these ETFs. And that can drive your cost up depending on, how often you trade. If you trade often, your trading cost can be high. If you're investing regular sums of money, okay? So if we go into our 401k, it contributes into the mutual fund just gradually, right? It's contributing into the mutual fund gradually. So we're not paying a fee. There's a fee built into the mutual fund, but we're not paying $10 every time we contribute more to our 401k to buy into that mutual fund, right? You're not. Okay? But when you buy an ETF, you can't contribute gradually like you can with the 401k. If I had like $100 taken out of my paycheck to go to my 401k or my IRA, it's not just automatically going to flow into an ETF. I'd have to buy the ETF. And if there's any trading costs associated with it, I'm not going to contribute, I'm not going to pay $10 to buy $100 worth of ETFs, right? Wouldn't make any sense. Be aware of high bid-ask spreads. Generally not a good time to buy or sell. So when can there be high bid and ask spreads? Maybe in an inefficient market. You know, let's say we look at like a Chilean ETF. That's actually become more popular over the last few years. But we might expect to see a higher spread between bid and ask in a Chilean ETF than we would in like a domestic US ETF or even like a Chinese ETF. Why? Because of, you know, illiquidity in trading, difficulty in the AP process. The AP process isn't perfect. There can be significant differences between the bid and ask spread. Not all ETFs are low cost. Some have to pay high licensing fees to use certain benchmarks. So benchmarks are all like proprietary to certain organizations. You know, the S&P 500. You know, State Street and a few other organizations have S&P 500 ETFs. They have to pay a licensing fee to Standard & Poor's. Standard & Poor's is owned by McGraw-Hill. McGraw-Hill, who also makes a lot of the textbooks we use. So, there's really no point to that little part of the story except just information. But, you know, the money flows to different places that you really wouldn't even consider. Tracking error. Indexes do not hold cash, but ETFs do, causing a cash drag. I think asking you guys about tracking error would be a fair question in a future quiz, right? Some index hold illiquid securities that the PM can have some discretion in holding, and will sample liquid securities instead. I don't know if I wrote that right. Some indexes hold illiquid securities that the PM has some discretion in holding, not have some discretion in holding. And will sample securities instead. So that can cause tracking error, right? We can replicate fully a benchmark. We can replicate every security in that whole benchmark and make it match identically and just have a little bit of cash, you know, which will cause a minimal cash drag. There is an acceptable tracking error. In a lot of fund information sheets, they'll say we anticipate a tracking error of like, you know, 0.05%. You know, that's our tolerance, right? But if we're holding like an obscure benchmark, like the Chilean index, right? Some securities in the Chilean index might not trade every day. They might not even trade once a week. So when the portfolio manager creates an ETF to match the Chilean index, he might make the decision, you know, this fund is still passive, but I can obtain the passive investment and pretty much get the same returns by not holding this one stock that's illiquid. That's very difficult to buy and sell. Because as you know, if we have a security that's difficult to buy and sell, it can have a significant impact on the portfolio, right? Because it's like buying or selling a house, as I've used that example before, right? Like, what's my house worth? What's my condo worth? Can I tell you exactly what it's worth? No. I'd have to put it out in the market and see what I got offered to really find out what it's worth, right? Some indexes hold dominant positions in certain stocks that would violate ETF regulations. This has actually been a problem with Apple. Apple has been such a, has grown so quickly and become such a high portion of some benchmarks that it violates mutual fund and ETF regulations for certain funds to hold any more Apple stock, right? But you want to hold Apple stock because Apple stock is such a high performer. It's actually, there are some organizations right now who want to have a benchmark X Apple, like not include Apple in the index, because the Apple stock is making the rest of the stock market look better than it really is. And if you're not allowed to hold more Apple stock because of regulations, you're kind of handicapping your portfolio and making it, well, you're not making it appear, you're then underperforming the benchmark possibly because you can't hold any more Apple stock. Now, I like Apple, but I would never buy Apple stock.
Why?
It's overpriced. You know, I mean, granted, you know, 5 years ago you looked and you compare now to Apple products. Everybody has Apple products, you know, and I didn't for the longest time. But you know, at the same time, it's like, well, how high can it go? Like, the valuations of Apple really warranted? You know, I mean, there's some people who are like cult-like addicted to Apple products. Like you know, the iPad 3 is coming out in a couple of weeks. You know, what is it going to do differently than the iPad 2?
Sorry.
They're gonna be sitting out the store.
But is that gonna come out in 2 weeks?
They could go 2 to 1.
What's that?
They could go 2 to 1.
2-1?
Yeah,
What do you mean?
I mean, they can split.
Stock split?
Yeah.
Yeah, the stock split doesn't really add any value. The stock
Yeah.
split is kind of like,
You just add more shares.
a stock split would be like taking my 1-bedroom condo and then cutting it in half and making 2 studio apartments. I still have the same square feet,
Yeah.
you know what I mean? I don't have any, you don't own more of the company. And that stock splits were really popular during the tech boom of the 90s, when like the stock would split and then it would double in price again. You know what I mean? But it was like, as we now know, looking back, completely unwarranted. So, I mean, in theory, I mean, if we had a stock split and the stock went up back to the original price, that's awesome. You've like doubled your money. A lot of times they do stock splits for pricing reasons, right? Like if Apple's at $500 a share, you know, it limits people who can buy it, right? Because I can only buy, you know, Apple stock in $500 increments, right? It'd be a lot easier to buy the Apple stock I wanted if I could buy it in, you know, $100 increments or $50 increments. So a lot of times they might do splits for that reason, more of like a psychological effect. That's it right there. Settlement dates. We've already talked about this. ETFs trade like equities, so they have a T+3 trade date. Mutual funds have a T+1 settlement date. Lower settlement times reduce the risk of trade failures. How does a trade failure happen? Well, let's say you're not really aware of your portfolio and how it works. I could buy, I could sell an ETF that has a T+3 trade settlement, right? I'm selling the ETF, I'm going to get cash in return. But then that same day, when I sell, I also buy a mutual fund, right? The mutual fund is going to settle the next day, but the ETF isn't going to settle for 3 days. So for 2 days, I'd be without the money to buy the mutual fund, and that's how a trade can fail. Does that make sense? That's the end of chapter 4 in the ETF book. We'll go on to chapter 5.